Hey everyone, Mike Wescamillo here. I have an exciting video for you today. It is the market forecast for 2022. We're including housing, mortgage, inflation, stocks. I'll give you a rundown of inflation throughout history. And I'm really excited to present this, so let's go. All right, I'll just pull up my screen right here. All right, so let's recap 2021. The forecast for 2021 was that we did expect rates to rise in the beginning of the year and recover into the fall. And what actually happened was that, although rates did rise sharply as anticipated, it recovered a bit earlier than expected and gained back most of its losses by late summer. Now, since that late summer of 2021, we've seen it creep back up due to high inflation. As far as housing goes, the forecast was for strong demand and tight supply that would help to push home prices up by single-digit percentages in the high single digits. What actually happened was that the COVID caused supply chain disruptions, labor shortages, which really helped to push real estate values even higher than our robust forecast. They're thinking maybe it was going to be in the single digits, but actually, and depending on the metrics that you look at, was anywhere from 11 to 18%. But keep in mind too that a few analysts were also thinking we experienced a drop in real estate values. So, all right. In 2022, the Fed will play a major role in tapering, rate hikes, balance sheet runoff. So tapering, if you didn't know already, that the Feds will continue tapering, in other words, buying less mortgage bonds at an accelerated pace in 2022. Buying mortgage bonds has been helping to keep the mortgage interest rates low, so there will be a direct effect on rates when they end purchasing. Plus, they're deciding whether or not to let their balance sheet run off instead of reinvesting and buying more bonds. I'll get more into that in a bit. All this can impact equity markets, drive interest rates higher, impact housing, and as well as jobs. So some voting members rotate each year, and there are 19 Fed members. 12 of them actually vote, but only 4 of them rotate in and out each year. So the composition of the 4 rotating members will be important this year. We're expecting them to be a little less accommodating and lean towards tightening up, because their main focus will be to combat the highest inflation we've actually experienced in 40 years. The Fed members are expected to raise the Fed rate to fight the inflation, and we'll likely see a negative reaction to that in the stock market, which could cause the Fed to lose their resolve, but we'll have to see where that goes. So the Feds should have raised the rate in 2021, but mistakenly thought inflation was transitory. But let's look at the history and help us forecast how the Fed actions in 2022 will influence the markets. So going back in history here, let's look back to late 1970. Burns was the Fed chair. He ignored inflation, which was rising rapidly, insisted inflation would be transitory. Does that sound familiar to you? Burns remained steadfast that inflation was transitory, and mortgage rates responded. You see, mortgage bonds hate inflation because it erodes the fixed return when investors buy them. Imagine holding a mortgage with a fixed return of 3%, and let's say that's your only income that you got from that. But inflation is driving pieces of consumer goods, groceries, gas, etc. higher and higher. It makes the value of your fixed income less and less over time. So to combat that, you have to increase the rate on your future loans. That's why mortgage rates rise when inflation rises. Year over year inflation ballooned from 7% in 1978 to 14% by the time he left. 14% inflation by the time he left in 1980. Burns remained steadfast that inflation was transient. Higher inflation caused mortgage rates to rise from 12 to 18%. Sometimes you think, oh, well, I don't want to get an interest rate if it's not, 3.0 or, can you imagine paying a mortgage rate of 18%? Woo! All right, let's move to the successor, Paul Volcker, and he comes in and he needs to fight the rapid inflation that we're experiencing. What he does is he hikes the federal funds rate from 11% to 20% in just 2 years. But it was effective in fighting inflation. Inflation dropped from 14% to below 5%. That's a huge drop. Because inflation dropped, mortgage rates sharply declined from 18% towards 12%. But there were consequences. The S&P 500 sharply declined by 30% during this time. Tighter monetary policy pushed the U.S. into recession in 1982. In the late 1990s, inflation under Alan Greenspan doubled from 1.75 to 3.5%. But the higher inflation caused mortgage rates to rise from 7 to 8.5%. Unlike Burns, though, Greenspan took action in mid-1999 and hiked the federal funds rate by 1.75, matching the rise of inflation from 4.75 to 6.5 in 1 year. So Greenspan saw what happened under Burns in the 1970s. He knew his actions were wrong, and he wanted to be proactive. So he didn't have to take the desperate measures like Volcker was forced to do. And so we saw inflation responded and dropped from 3.5% towards 1%. Mortgage rates then dropped from 8.5% to 5.5%. That's a big drop, and that sparked a huge refi boom. But there were consequences. S&P 500 fell by 50% from spring to fall of 2000, and the U.S. entered another recession in 2001. So twice now in history, we had to fight inflation. Both times the stock market didn't like it, which resulted in 2 separate recessions. All right, so today under Jerome Powell, inflation increased from 1.75, nice healthy rate, all the way up to 7%. And Powell thought it was transitory. Again, sound familiar? Higher inflation caused mortgage rates to rise from 2.5% to 3.375. So the Fed is currently tapering their purchases of mortgage bonds and treasuries, but they will not hike and reduce purchases at the same time. So they're going to reduce the purchases of the mortgage bonds right now, but wait until that is all done and then decide to hike the federal fund rate. The tapering is expected to be done in March, likely begin hiking the rate in May. The Fed is targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. Powell allowed inflation to rise from 1.75% all the way up to 7%. And he also made the mistake of Burns by thinking it was transitory. Greenspan seemed to learn, but Powell fell into the same trap as Arthur Burns. Inflation and interest rates can still rise until the Fed acts. So, do expect that inflation will continue to rise and the mortgage rates will follow. If the Fed rate can tame inflation, mortgage rates should drop, but maybe from higher levels. Let's say it goes up to all the way up to 4%, and then we could see a drop, but that might be down to 3.5 or so. All right, so to recap, let's see if we can see a pattern here. Here's a recap of the Fed chair. Who was the Fed chair at the time, and how much inflation rose. Let's look at the mortgage rates during that time. As you can see, inflation has a direct response to mortgage rates. So under Burns and Volcker, inflation went from 7 to 14%. Mortgage rates then responded, going 12 to 18%. Under Greenspan, it went from 2 to 3.5%, and then the rates followed from 7 to 8.5%. Now, under Powell, we're seeing inflation go from 2 to 7%, and mortgage rates go from 2.5 to 3.375. Now, you'll notice an increase of 5% of inflation under Powell, but the rates haven't increased that much. That's because the government's purchasing a lot of mortgage bonds each month. That's helping to slow down the hike of mortgage rates. When the Fed starts tapering the purchase of those mortgage bonds, we'll really start to see the higher rates in mortgages. To fight inflation, these Fed chairs raise the Fed funds rate. So under Burns-Volcker, it went from 11 to 20%. Under Greenspan, it went from 4.75% to 6.5%. And currently under Powell, it's near zero or zero, just call it zero. To 1% is what's expected in 2022. Whether they get there or not, we'll see. The response from inflation has been really good. So we saw after the Fed funds rate, the inflation response went from 14 to 5% under Burns-Volcker, 8.5% to 1% under Greenspan, and under Powell, we should see a drop. If history shows us anything, we should see some kind of drop on that. Now, the mortgage rate response to the inflation dropping under Burns-Volcker went from 18 to 12%. Under Greenspan, went from 8.5% to 5.5%. Those are all significant drops. They're like a third of the actual rate. And we should see a decline as well as inflation declines under Powell. Now, of course, this isn't without consequences. Under Burns-Volcker, we saw a S&P 500 drop 30%, and then following that was a recession. Under Greenspan, it dropped 50%, and of course, we saw a recession after that. So today, under Powell, we see that stocks are expensive, the economy is slowing, and measured by many metrics today, and I'll get into that a little further in a little bit, we see that stocks are inflated compared to how the economy is actually doing. Could we see a stock market decline followed by a recession? Yeah, signs are pretty good that this will happen. Now, let's introduce some of the wild cards. Wild card, of course, look in the background here, we're seeing COVID. COVID played a major influence on monetary policy and supply chains, and it will still continue to do so. A major surprise in COVID could change the outlook dramatically. So what if we get another bad surge of COVID and another round of stimulus is introduced? Sure, it can help short term. The stocks will be driven higher. Mortgage rates will likely go higher as well because of inflation. But it will make the Fed's job of corralling inflation a lot more difficult. The runoff of the Fed balance sheet, which I mentioned earlier, is going to be very important because right now the Feds are still buying new mortgage bonds and treasuries, but are expected to taper this in the spring. After that, we should see the Fed funds rate hike up a bit. At the same time, though, the Feds are still buying $70 billion a month in mortgage bonds through reinvestments. Reinvestments like when you pay off a mortgage through refinancing or selling a home, and that's been keeping the rates low. However, the wild card is if and when they decide to stop that, mortgage rates could move higher than previously thought. So let's look at the stock market forecast. Now, stocks at this point are very expensive. By nearly every measure, this is the most expensive stock market out there. We know that a Fed rate hike is coming, and we know historically what kind of reaction the stock market has to it. So we could see a price to earning multiples out there contract, resulting in lower stock prices, as we've seen in the past. The forecast calls for around a 10% decline in major stock prices in 2022 because the Feds will be less accommodative. Now for the interest rate forecast, inflation will likely continue rising through February, and with the Feds tapering at the same time, mortgage-backed securities won't like that, so expect a move towards 3.75% in the first part of the year. With the Fed acting to a softer stock market and slowing economic conditions, we should see interest rates head lower in the second part of the year, maybe down to the 3% level, give or take. So we could see rate hikes in the first half of the year and a decline towards 3% in the second half, which may cause another refi boom. So let's think of this strategically here. If you are a current home buyer or want to refinance to maybe take advantage of your home's equity that you've built, my suggestion is to go get a loan with lower fees. Don't buy down your interest rate with points, because we very well could see lower rates towards the end of 2022. Housing will remain strong in 2022, but not as strong as 2021. Demand may be slightly softer due to a rise in interest rates, but still very robust. Supply will increase, but will remain tight because of issues in shortages in labor, semiconductors, and supply chain disruptions. Semiconductor shortages affect new home builds because as homes are getting smarter, more computer chips are needed. Take a look at all the new refrigerators, washers, dryers out there. They require chips nowadays. And let's not forget the wild cards out there that could push everything back again. Our forecast for homeowners is to expect a mid to high single-digit appreciation through the year. This will continue to provide a great wealth creation opportunity for homeowners, as difficult as it may be to get into a home. But it's still a really good time to buy a home. Hey, thanks again for watching this video. If you have learned anything from it, make sure you let me know in the comments below. And if you really like the video, hit that like button. If you dislike it, you can do that too. But please share and subscribe for more content coming. All right, thank you. Take care.